Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Let's go back to the chart of the YUK that we were looking at. And we have this trend development here where there's 1, 2, 3 waves of downside. And what you will see is that the amount of time between waves 1 and 2 and between 2 and 3 is very, very comparable. You have about the same number of bars between each of those. And because of that, we know that following this third drop, it is more likely to have a larger correction than A or B. So even if it doesn't have a trend reversal, it's going to have a larger correction where maybe it just bases out longer and then continues. In either case, you're going to have something that extends that move. And going off of this, because this had larger upside momentum compared to this, so B was stronger than A, we know that there's probably going to be a stronger reversal or break through this upper trend channel than if B had been more gradual than A. If B had been more gradual than A, then we might have had an attempt at a fourth low where it served as a trap before it reversed it. Something that allowed the momentum to shift a little bit better at this low than hitting that initial low itself. Let me draw that a little bit more clearly. So let's say we've got 3 lows here, and going into the third one, we have this slower move compared to this previous drop. So it might go and attempt to retest it, but it could even do it again for a third time, creating that momentum reversal that we saw on the EUI, for example, except we saw that off of highs. So it's the same type of thing here. If you actually pull up the euro, the euro dollar, you'll see this type of thing actually forming on the daily time frame here. So basically, what we want to keep in mind is that when we are looking at timing the market and basically placing not only our entries and our exits, we want to look at how these different building blocks come into play and how they relate one to another. And by developing an understanding of the relationship between them, we can determine whether we really want to take a setup or not, how risky that setup is compared to, say, other setups that might fall into the same category of strategy. And it's a really great way for not only reducing the risk that we have to take, but also determining, how aggressive we want to be with the number of trades that we take. So I'm going to stop here, and we're running out of time. I have about 5 minutes left, though, that I'd like to take some time to take questions. For those of you that would like to contact me, you can reach me at tonihansen.com. I do have an email address up here, but a better email to reach me at will be info@tradingfrommainstreet.com. And Trading from Main Street is just spelled out. So TradingFromMainStreet.com. That one is not inundated with spam like this one is. So that's a great address to reach me at if you have any more questions that I don't get to today. I'd also like to let you guys know that I do have a special available for this class. So for those of you that have attended today's session, I go into my building blocks into a lot greater detail in my Trading Made Simple series, and the main core product of this is the 5 technical signals you should not trade without. And these 5 technical signals are basically these 5 building blocks. And this course in particular is about 10 hours over 400 pages of text. So it goes really in depth into the things that we basically took about 45 minutes here covering today. Susan asks, can these patterns be applied to stock moves? Most definitely. I mean, everything that I went through today, these are the same strategies, the same system that I use on every single market I'm trading, whether I'm trading Forex, stocks, futures, it doesn't matter. The same strategies apply to all markets, and they apply to all time frames as well. You know, there's some strategies that are like gap specific. So I'll use like those when trading stocks in the morning, for instance, like morning plays on gaps. But generally speaking, these patterns are all going to basically form on no matter what security or time frame that you're looking at. Jen asked, you know, how do you place your stop? This is a really good question. When you're looking at stops levels, basically what we are looking at are these support and resistance zones. Let me just show you this here, for example. When you are placing these stops, you want your stop to be on the opposite side of a support or resistance level. So I typically have an idea of where my stop is going to be placed going into a position, and I will enter it as a bracket order with my actual entry trigger. So on this, for example, this A breakdown here, and this is a strategy that I call an avalanche. On this strategy, I place my stop over the last high within this trading range marked A. Sometimes it's slightly higher than, as we saw earlier, you know, trend patterns, they often have like a two-wave continuation, sometimes a little bit longer base. But I'll place it over that second high within that base, and that will be my stop level. And my entry, I will use that last end of the channel itself, and as that channel breaks, I will take that as an entry. I will use multiple time frames though. So if I see something forming on a daily time frame, then I'm going to drop down. I'm going to drop down to a smaller time frame as well. Can you guys still hear me okay?
Oh, yes.
Okay.
Definitely.
All right, some people said they lost audio, so I wanted to make sure I'm still here and not talking to myself.
No.
Okay, so my stop is going to be placed over that level, and the tighter you can keep a stop, obviously the better. So it's really important to use multiple time frames because that's how you can really narrow things down and keep those tighter stops. And when you're using the building blocks, you can do that because, you know, like I said with that channel example, you might have a channel and you're looking for a breakdown, but within that channel itself, there's a shift in momentum. You don't have to keep your stop all the way at the upper end of that channel. You can keep it above that last zone within that channel before it broke lower. And you can even use that level there as your entry trigger, and it might be a little bit higher than the low of the entire trading range. And that does scare a lot of people because they think that those previous lows are going to serve as support. But what you have to keep in mind is that this entire channel is forming at a support level, if it's a breakdown here. And so really when you're breaking that smaller channel, you are also going to be triggering a break in that larger channel. And, you know, if this is angled a little bit, yeah, it might pause for a minute at a previous low, but it's typically going to break through it pretty quickly unless you had more of like a V bottom here, in which case you would be dealing with what we looked at back here. Let me pull it up. Way back here. Oops, too far. And so if you're dealing with like a V, then obviously that previous low zone is going to serve as support.
Thank you for participating in this week's session. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.